I do forget that. I only knew this. Yeah,
All rise, silence in court.
Be seated, thank you.
Application CICS 1/2025 on the Commission's own motion 2025 State Wage Case Order pursuant to Section 50A of the Act.
Yes, we'll take appearances. Mr Entrican for the Minister this morning.
Yes, Chief Commissioner.
Thank you. And Mr Harding and Mr Collins for CCR WA.
Yes, Chief Commissioner.
Thank you very much. And for Unions WA, Mr Snedden.
Chief Commissioner.
Thank you. Ms Hendon and Mr Hanson behind you.
Yes.
Thank you very much. Now for WACOS, we have Ms Hance.
Yes, Commissioner.
Thank you. And for WALGA, we have Ms Love and Ms Lyne.
Thank you, Chief Commissioner.
Very well, thank you. Now, I think we wrote to you on the 16th of May to indicate the order of presentation of cases, and we assume that no longer doesn't cause any difficulty for anybody at the bar table. There's no change to that order, so we'll assume that to be the case. Are there any preliminary issues that we need to deal with before we get underway? We're assuming we're going to hear from Mr Christmas first, Mr Entrick, in accordance with the usual arrangements. We should also note, of course, that as we've advised previously, we do have time reserved tomorrow if it is necessary to take further time beyond today. Also, we should observe that, as the parties would be aware, once the Fair Work Commission hands down its decision in the 2025 annual wage review, we will resume on a date to be fixed convenient to the Commission to hear from you about that particular decision. So otherwise, we're in your hands, Mr Entrican.
Thank you, Chief Commissioner. If it pleases the Commission and Court session, I appear on behalf of the Minister for Industrial Relations. We'll begin with our usual presentation by our expert witness, Mr Christmas from the Department of Treasury, and that'll be followed by an opportunity for questions, if there are any. And then I'll address the Minister's position as outlined in the submissions. If it pleases the Commission and Court session, we'll now call Mr Christmas to the witness box.
Mr Christmas, please come forward, thank you.
Please state your full name and address.
David Brian Christmas and 28 Barrack Street, Perth.
Do you sincerely declare and affirm that the evidence you shall give to the Commission shall be the truth, the whole truth and nothing but the truth?
I do. Thank you.
Be seated, thanks very much, Mr Christmas, and welcome back.
Thanks, Chief Commissioner.
Yes, Mr Entrican.
Yes. Thank you, Chief. Mr Christmas, can I confirm that you've made a witness statement for these proceedings?
I did.
That's all right. Thank you.
I have a copy here.
That's okay.
The original.
Yes, thank you. Mr Christmas, your witness statement states that you and your colleagues at the Department of Treasury have prepared the Economic Outlook document submitted as attachment A to the Minister's primary submission. If it's convenient at this point, Chief Commissioner, I'll seek to tender the PowerPoint presentation from Mr Christmas that he'll be speaking to today.
Yes, the PowerPoint presentation by Mr Christmas on behalf of the Minister will be Exhibit Minister 1.
Thank you. I have some copies for the other parties. Great, thanks.
Yes, thank you very much, Mr Entrican.
Right. Thank you, Mr Christmas. Could you take us through your presentation?
Thank you, and thanks for the opportunity to present again. So today's state wage case presentation is essentially, it's based on an assessment of the WA economy as published in the 24-25 pre-election financial projection statement, which was released on the 7th of February. It will include references to data released since then, the state budget will be out later in June, so that'll contain our next assessment of the conditions in WA economy. It also refers to the 25-6 Commonwealth budget released in March and the IMF's latest released World Economic Outlook released in April. So key points: West Australia's domestic economy as measured by state final demand grew by 3.7% in calendar 24, the strongest growth of all states, with the PFBS forecasting growth of 3.75% in 24-5 and around 3% per annum in 25-6 and 26-7. The pre-election financial projection statement forecast GSP growth to lift in 24-5 and 25-6. This is supported by ongoing growth in domestic demand and a recovery in goods exports, which declined in 23-24 and act as a drag on growth in that year. Latest data show a modest risk to achieving the forecast growth in SFD, as well as risk to forecast growth in goods exports, resulting in overall downside risk to the GSP forecast for 24-5. The strength of the domestic economy has driven record employment outcomes, with continuing strong growth in employment and an average unemployment rate that is historically low. With the labour market conditions expected to ease, in line with moderation of growth in the domestic economy, the unemployment rate is still projected to remain below the historical average. And despite the strong labour market conditions, wages growth has been easing. However, wages growth is now outpacing consumer price inflation, which has been easing as well, resulting in real wage growth over the year to March quarter 2025. This trend is expected to be sustained over the forecast period. While the Trump tariffs, the tariffs announced by the US President, have elevated uncertainty about global outlook, the direct impact on West Australia is negligible, given the amount of trade the state has with the US, but indirect impacts could be larger. This will depend on how things play out, and it also depends on Chinese authorities and their commitment to maintaining growth, and that will mitigate some of the risks from the trade tariffs. I'll also touch on other risks at the end of the presentation. So just starting off with that global and national context. So between January 25 and April 25, the IMF's assessment of conditions in those 2 points of time, the US President announced significant tariff increases on every country of around 10%, and with increases over and above that for a number of other countries, some of them quite significant. Some of those have been delayed. Particularly large increases were levied against China, and China did retaliate. Both countries have de-escalated their tariffs, but tariffs rates are still in the on US goods. On Chinese goods coming into the US are still around the 50% level, and Chinese tariffs on US are around 30%. So those will be reviewed. There's a 90-day cooling off period where they can sort wherever they want to go out after that. Anyway, those increases that I've just talked about have resulted in considerable uncertainty, and they're the reason the IMF downgraded its forecast for the global economy, which was forecast to grow by about 3% per annum in 25-26 in January, and then they've been downgraded to a little bit less than that in 2.8% in 25 and 3% in 26. And the strongest downgrades are really for the two countries most involved, plus a number of other countries that have close trade, for example, with China. So the ASEAN and a number of other countries have had their forecast growth rates revised. In terms of inflation, actually the global story is a lot better. So global inflation has come down significantly since in the last 2 years, sufficiently so that most central banks have been cutting rates. The Federal Reserve in the US last cut was in December, and its latest statement says that it's holding rates around the 4.3% mark, reflecting that annual inflation is still above its target of 2%, and the uncertainty about the economic outlook has increased further. And the risks of higher employment and higher inflation have risen. So it's just monitoring conditions, and we'll respond accordingly as things play out. So just going back to that last slide, that downgrade was made before the de-escalation, so they may shift it a little bit, but it's so live that they're not going to republish numbers till probably mid-year. Going to the global context in China, China's economy expanded by 5.4% in year-ended terms in March quarter, underpinned by strong growth in consumption, but that's mainly government consumption, not household consumption. And I'll show you a chart in a minute on that. And it's also focused heavily on exports. So that's why this is the timing of these tariffs isn't the best, because China is actually relying on exports for not quite half of its growth, but at least a third of its growth, probably a bit more than a third based on the chart there. It continues to face challenges, including its prolonged downturn in the property sector and subdued consumer and business sentiment. The IMF has downgraded. So while the authorities are still targeting 5%, and they've indicated they'll do what it takes to get to 5%, the IMF has got a slightly lower number for 4% for both 25 and 26. As you can see on the right-hand chart of this slide, China's growth rate has been coming down for some while, and there are longer-term issues, including that the country's population is actually contracting, and it contracted for the third year in 2024. Just in terms of a bit more detail, so investment in infrastructure in China has been strong, and as has investment in manufacturing, but investment in the real estate sector has been declining for 3 years, consistent with that weakness in property market, which is characterised by oversupply and house prices are off their peaks. So given that a lot of Chinese household wealth is held in property, that has not been good for consumer demand. And you can see on that right-hand chart that consumer or China retail sales really aren't increasing at the pace they used to prior to the COVID, which was early starting. It's that 2020 period where it really took a dip, but the trend rate since COVID is a lot less than it was prior, and China hasn't even caught up to the previous trend yet. So those are things that household sector is quite a concern as far as China goes. Despite everything, the WA Commodity Price Index has trended down over recent years, but it is elevated still. And iron ore prices are a big part of that. They're still at today, they were $100 per tonne. And we also have very strong gold prices as well. So those two have remained strong into the June quarter, so or at least elevated. So the prices for the June quarter should remain elevated historically. And I mentioned the Aussie dollar averaged 64.8 cents over the year to date, which is down slightly from an average of 65.6 last financial year. Just in terms of a slide on the impact of US trade policy and responses, as I mentioned before, WA exports to the US in 2024 amounted to 1.4% of our total exports. That's mainly gold, and gold is it shifts easily from one destination to another, given the nature of the product. So it'll find a home somewhere, and there's obviously strong demand given the price is so high. So there's a minimal direct impact, potentially larger indirect impacts, so lower demand for Chinese exports, which embody iron ore processed into steel in from China, or lower global growth just because of the uncertainty and things like supply chains being interrupted and that sort of thing. And there may be a redirection of trade. All that takes time and can be disruptive. And then probably the most uncertain and hardest to measure would be confidence effects, uncertainty on household spending and business investment, probably primarily in those countries that are directly affected, but there could be spillovers to our own household or business. And I'll get to some charts on that in a second. China exports. So China only exports about 11% of its steel production. So most of its steel production is domestically consumed, although about 12% is embodied in other exports like vehicles and machinery and things. So, and that around 6% to the next North America, I think that's 6% of total Chinese exports of steel, not 6% of total Chinese steel production. So it's quite small. Mitigators of the impact, and why that's important is because the bulk of our exports to China obviously is iron ore. Mitigators of the impacts of all this, Chinese policy stimulus. So China has already instituted some policy initiatives, mainly monetary type policy, with some additional spending or approved for infrastructure, but it's trying not to overstimulate the infrastructure if it can. It certainly doesn't want to do it in the housing sector if it can, because the housing sector's already been impacted by past stimulus. So there's a bit more infrastructure spending, but they've clearly signalled readiness to do more if that's what it takes. And there's always the potential for a depreciation of the Aussie dollar if there's a significant economic deterioration nationally. Just in terms of the national story, Australia's been able to maintain continuous economic growth and preserve labour market gains, including maintaining a low unemployment rate, while at the same time recording a substantial moderation in inflation. So while the real GDP outcome for 23-4 and 24-5 is modest by the projected standards and by historical standards, it's still certainly positive, and that's happening at a time where the labour market's tight. But importantly, CPI is falling and wages are easing as well. The Commonwealth Budget observes that GDP growth picked up at the end of 24, and this momentum is expected to continue into in the coming years, with GDP forecast to grow by 1.5% this year, but increasing to 2.25 in 25-6 and each of the out years, that it's a step increase in each year. The improvement in growth is expected to be broad-based, supported by a gradual recovery in the private final demand over the forecast period. So household spending is expected to recover after stalling in mid-2024, underpinned by strong employment and wage growth, tax cuts and easing inflation. Business investment is expected to contribute to growth over the forecast period, supported by renewable energy infrastructure, warehouses and data centres. And dwelling investment is expected to accelerate in 25-26 in response to robust housing demand as supply-side constraints ease and financing costs come off. And just in terms of that financing costs come off, you'd most likely be aware that the Reserve Bank cut its rates by 0.25% yesterday, and that's showing comfort that the inflation rate at the national level is going to stay within its target once you remove some short-term volatility, including through policy like the household electricity credits, which do push growth around a bit. So it also sees the upside risk. It was concerned about the upside risk to inflation actually getting stronger. It sees that as more balanced at its assessment yesterday. And obviously it's keeping an eye to the fact that global uncertainty may be something that impacts it as well, although it has sort of suggested that maybe that it will even, in the past it's thought it could impact either way on inflation. I think it's, obviously it's comfortable enough now that it's going to stay within the range. And the market, this is actually a chart which came out before yesterday's cut, but it indicates the market's expecting several more over and above yesterday's.
Certainly the RBA appears more comfortable now than it
Yes.
was 6 months ago.
Certainly, yep. So turning to the WA economy, consumer sentiment has been volatile and historically weak in recent years, COVID related, and even since consumer sentiment as measured by Westpac Melbourne Institute declined sharply in April after, some of its survey was after the Trump announcement. So it declined by 13 points, from 96 points to 83. However, it's largely retraced that. It went from 97 points to 83 and now it's back at 96. So essentially, equity markets around the world actually fell dramatically, and so consumer sentiment responded.
Fell away pretty quickly.
But yeah, they've also retraced and in fact a bit higher now in most cases or key cases. So equities markets are back above pre-April levels, and so sentiment's improved accordingly. But what this chart shows also is there are periods where consumer sentiment may be negative, but consumers are still prepared to spend. So it's certainly not a one-for-one type of link up to, say, just before the GFC, well, actually even to maybe 2013-14, which is roughly when the mining boom ended, or mining investment boom ended. You could see they tracked each other quite well, but since then they don't track each other as well. So it's hard to be definitive about consumer sentiment and the impact on spending. And likewise for NAB business confidence, in April, conducted 3 weeks after the 2 April so-called Liberation Day tariff announcements, was largely unchanged from March, and the swings you see evident in the chart up there actually occurred between January and February. So it just shows that you can have volatility, even more volatility without having any announcements than you have with. So it just puts them in perspective. So what's actually happened with spending? So household spending has eased. So in 2024 it was 2%, down from 4.5% a year earlier. So that moderation's been there has been moderation in primarily discretionary spending, and that's not surprising given that interest rates were higher until recently, and even those cuts they take a lag. They have a lagged effect anyway.
About 6 months sometimes, isn't
Yeah.
it, roughly? I
Yes,
think,
that's correct.
on the data.
Yep, that's correct, Chief Commissioner. So that would have caused a slowing in discretionary spending, plus the higher rates of inflation that were there when spending was particularly before. The high rates of inflation would have caused that easing in spending. The reason discretionary spending has held up quite a lot is because, until very recently, as a total, is because West Australians love travel, and once the borders were reopened, we started travelling a lot more, and so our spend on travel really boosted overall discretionary spending. But when you take that out of travel out of it, you can see that the black line there really came off a lot earlier. It's travel that's been boosting that discretionary spend. Overall, though, we're spending around, our spending grew by 2% in annual average terms, and that it was a lot higher than in the other states, and almost double actually a lot much higher than that
Seems
nationally.
like more than double the
yeah,
national
more
level.
than double nationally. Almost, three times actually. Nationally was 0.6 and 24. So yeah. Retail volumes. So this is slightly later data. So the latest national accounts data is to December. Next set of data comes out in the first week of June. So retail trade, the partial indicators give you some sort of indication of what's happening since then. So retail trade, that accounts for around a third of total household consumption. That bottomed out and started increasing in the March quarter. So in annual average terms, it grew by 1.9% in the March quarter and 2.9% in year-ended terms. The ABS is actually going to replace the retail trade survey with a monthly household spending indicator, which actually accounts for almost 2/3 of the household consumption base, and that's using a raft of other data sources, including aggregate bank card transaction data, supermarket scanner data, vehicle sales data. So that's why it's broader, and that's still, while that's showing in year-ended terms that there was still a trend decline in household spending of that basket of goods, it's still very high at 4% and much higher than nationally, which was 0.3. So our households are doing a lot better than nationally is the key. The resilience has been much higher. And that's probably in part because our households in aggregate, because there will be households that are challenged, and I don't want to take away from that, but in aggregate, our households are saving quite substantially. Our household savings rate a lot higher than nationally, and I've been making that point for several years now. It has declined, but we're still at our net household saving rate is well in excess of 10%. And you can also see how residential mortgage arrears, which we get from S&P Global, those arrears used to be substantially higher than nationally, and now they're very close to national. So households are trying to make sure their finances are in good shape in aggregate terms. So that's why the PFPS forecast was for household consumption to increase by 2.5% in 24/5, up from the 2% in 24, and then rising to 3% in 25/6 and 26/7. And some of that improvement is also supported by population. The fundamentals are still solid. So even though population growth is a bit slower, you're still having very solid outcomes. Turning to the housing market, the number of homes being completed and commenced both picked up in the second half of last year, which you can see in the left-hand chart there on that slide. That said, and the number of homes under construction is high, but the market's still been constrained by labour shortages. And it's interesting that even though the number of homes commenced and completed increased dramatically, we did find that dwelling investment actually declined in the it increased in the September quarter by 4.3%, but then declined in the December quarter by 2.1%. So we're not seeing necessarily that translated into what the National Accounts measure of dwelling investment. So we think, it does show that those labour constraints are impacting on the amount of work they can do in any quarter. In terms of going in the future, how building approvals did jump up substantially from through last year, and those do track commencements quite well. But so we would expect commencements to stay elevated, at least for the very near term, but slightly leading indicators that have a slightly longer lead, like HIA, new home sales, and do suggest there'll be a moderation in those approvals. You're probably talking again in 6 months' time from that peak, maybe even sooner. But what it's telling us is those approvals, while they may be elevated, aren't going to stay as high as what you see there. So our PFPS forecasts are for dwelling investment to lift from 4.2% in 23/4 to 11.25% in 4/5 and almost 10% in 5/6. Turning to business investment, the pre-election financial projection statement forecasts investment to consolidate at a high level. So we actually, you can see from that slide on the left-hand side of that chart, the chart on the left-hand side of the slide, you can see a big jump in 23/4, and that's largely to do with ramp-up of work on Scarborough and Pluto project, which is worth more. It's actually worth, they've upgraded those CapEx numbers. That was the number we had at the time of the PFPS. But I think it's something more like it's over 18 billion now. So it's by far our largest project. So when that ramped up, that really picked up our total investment, and now we're just expecting that as that level to consolidate this year and then start increase again thereafter. And there's a range of other projects that are going to support investment over the forecast period. You can see some of them there. But there's also, which we haven't concluded specifically, there's a lot of work on decarbonisation spend, particularly by the very big companies, and also a lot of work being done on sustaining CapEx. And they don't always break that down into specific projects. So there is the big pipeline of support. In terms of, domestic economy as a whole, WA's domestic economy grew by 3.7, as I mentioned at the start. The PFPS forecasts SFD to grow by 3.75% in 4.5, with all components expected to contribute to that expansion. Although business investment is only making a small contribution this year.
Compared to last year.
Compared to last
which
year.
pushed the figure up significantly.
Yes, that's correct. That's correct. Yeah. And then 2.75% forecast growth in 5.6, mainly as when public spending is expected to soften a bit. So that's why one of the reasons you have that growth coming off a bit. Given trends to date in household spending, so given that household, you could see that monthly household spending indicator was coming down slightly. There's some risk, and also building work hasn't actually really bumped up because of the labour market constraints. There is some downside, modest downside risk to that forecast for SFG growth in 24-25. The external sector, so the PFPS projects goods exports to stabilise with no growth expected in 24-5, following a decline of 3.75% in 23-4. So the fall in 23-4 reflected a combination of a decline in grains exports due to a smaller harvest in 23, reduced LNG production, as some of the capacity comes out of that market, and there were some outages as well, and lower mineral production, notably nickel. The nickel market was impacted by Chinese investment in Indonesia, which made things very challenging for our companies. We're expecting stable level of exports. Well, the pre-election financial projections statement expects stable export levels in 24-5, and that was revised down from the mid-year review, which had a small increase in exports, and part of the reason for that was tropical cyclone Sean reduced iron ore exports late last year. And we're also expecting some weakness. Obviously, still nickel is down because of mine closures, and in the second half of 24, grain exports were still weak. But we do expect some expansion in lithium, although at lower rates than we thought previously. Where we do have a risk since the PFPS cut-off date, which the balance of payments data was released, and that does show merchandise exports fell by 4.1% in calendar 24. So there is a bit of catching up to do in this first half of 25. So beyond 25, goods exports are expected to grow, and supported by growth in Scarborough's going to come online, Scarborough Pluto, plus growth in lithium exports and some iron ore ramp up, some projects like Iron Bridge and Onslow Iron. So we do expect growth to be stronger in those out years. In terms of imports, they're very much determined by consumption and investment patterns, and our services exports and imports, after both growing very strongly to recover to pre-COVID levels, are starting to normalise. And in any case, they're not bigger components of activity as exports. So the overall picture, we've got the PFPS forecast growth of 2.25% in 24-5. That's a pickup from 0.5% the year earlier. And then the PFPS projects growth to pick up to around 2.5% per annum in the following years. I should note that over that period, the outlook is very much supported by domestic activity, as it has been since COVID started. Although net exports are expected to contribute in those later years. As discussed, data released since the PFPS was finalised has shown a modest risk to the state final demand forecast and a more material risk to the GSP forecast. In terms of population, year-ended growth, population growth has been strong, but it is coming off. So year-ended growth of 3.4% in September 23 was the recent peak, and that equated to around 96,000 additional people, more than 96,000 additional West Australians in that time. And the latest data, so population data, is actually lagged a lot, and the latest data is to September 24, and that's growing at 2.5% in year-ended terms, and that equates to about 72,600 people. So migration is coming off as well. Net overseas migration was around 70,600 people in the year to September 23, and that's now closer to 51,000 people to September 24. And that includes a rapid decline in student migration, and you can see that from the right-hand panel there. So at the peak, there was about 45% of net overseas migration was from students, and that's normalising now, including from some Commonwealth Government policy to tighten up on student migration. We're forecasting population growth to continue easing. So in 23-4, we've got population growth estimated at about 2.8%, followed by 1.9% in 24-25, and going out to 1.8% per annum in 5, 6 and 6, 7. So turning to the labour market, labour market tests have been surprisingly strong. There's more than 1.64 million people now employed. We're slightly off a peak. That peak with some very small reductions in employment in the last 2 months. Nevertheless, in annual average terms, which is less volatile, you've got employment growing by 3.3%, which is very, very strong. Most of that was from full-time employment, so full-time employment grew by 4%, accounting for, I think it was about 2.8% of the 3.3 overall, and then part-time employment grew by 1.8, or contributing 0.6% of that increase.
I think a few years ago it was a reverse.
Yes.
There was a significant growth in part-timers at the expense of full-time. It seems to have now flipped the other way.
Yes, that's correct. And you can see that on the chart. There's that massive increase in part-time just as we came out of COVID. Yeah. So that's correct. And what that recent trend has meant is in hours worked has been slightly higher than growth has been slightly higher than total employment growth. The strongest industries of growth, so public administration and safety, followed by construction, utilities, accommodation and food, and admin and support. So very strong growth in those industries. And despite moderating job vacancies, so moderating from April 23 record levels, monthly vacancy numbers are still well up relative to pre-pandemic, and even relative to the mining industry boom. They're very strong. Well, they're elevated at similar levels, I suppose, to the mining boom levels, just even a touch higher. So that says there's still demand out there. But we have the PFPS does forecast employment to grow this year by 3.25% in 24-5, before moderating to 1.75 in 25-6. And that moderation is in line with slower growth in the domestic economy. but it's also consistent with a slower supply as population growth comes off as well. But you can see right now we've got 3.3% growth over the year to April. We actually, because of the last 2 months where we had slight declines in employment, there is a slight downside risk to that forecast for 24/5. But again, it's pretty modest given that we're almost, we're a large way through the year anyway. So I'm just flagging that. In terms of our unemployment rate, that has averaged 3.7% in annual terms in April, only marginally higher than last year, so it's historically low. We do have that forecast. I'll get to the forecast in a minute. Youth unemployment's averaged 8.3 in the year to April. Again, that's the lowest of the state, so that's another good result, and it shows our labour market conditions are very strong. And the PFPF forecast is for the unemployment rate to average 3.5. Well, we did have a big jump in April, with bearing in mind monthly data is very volatile, but the unemployment rate did jump to 4.2%. So that means there's some upside risk to our forecast of 3.5, but again, that would be modest. So the participation rate has remained elevated in 24/5 to date. So it's in annual average terms, it's averaging at a 68.9 in April. And we are forecasting a rate of 69 over the year and to remain elevated next year at 68.9, after which we do see it coming off, and that's largely because of ageing of the population. So just going into wages, our preferred measure is the wage price index because it doesn't have it's not so exposed to changes in composition as other indicators of wage. Wages did grow by 4.7% in the December quarter 23, and that's eased now to 3.7% in the March quarter 25. There was a bit of a jump in the March quarter, you can see. So it jumped from 3.3% to up to 3.5%. Sorry, 3.7% in the March quarter, and that's largely because a number of very big public sector agreements came into the base in the March quarter. We're still expecting, industries where it's strong: education, accommodation, food, and professional services and healthcare are the areas that are where it's in excess of 3.5%. Growth. If we use other indicators of what might be happening, which are lead indicators, so this gives us April data, whereas we've only got WPI data till March. So, but even that's sort of showing that the SEEK advertised salary index is coming off from close to 5% to around 3.5% at the moment. That is slightly higher than it was earlier in the year. But if you look at the monthly data, there's a couple of very strong years and strong increases in January and February, and that's since come off. So in terms of our wage growth forecasts, the PFPS suggests them easing from 4.2 in the last 2 full financial years, coming off to 3.75% in 4.5 and then 3.5% in 25/6. So we do have that tapering over time. So inflation, we forecast excluding the electricity subcomponent simply because the household electricity credit pushes the number around, and it's, we've had about 4 of them now, so it keeps doing it. So just so we have that said, you can see the CPI excluding electricity and tracks over time it's tracking the same basic profile as headline CPI. And that is tracking downwards, so growth in our CPI excluding electricity eased to 3.4% in year-ended terms in the March quarter. And you can see from that right-hand chart that there's more than 50 out of the 87 components of the CPI basket actually have falling inflation, so that's whereas there's a much smaller number which are increasing. One of the areas of strength actually in the CPI has been in our housing. So the cost of new housing to households is still quite elevated. It is coming off, but it is elevated. So as an example, I think new dwelling inflation in Perth was 10.1% in the year to March 25 compared to 1.4 nationally. So new dwelling prices are high because of those labour and material constraints that were evident earlier after COVID, particularly material. That's come off, but its labour constraints are still sort of...
I suppose that's one of the effects of the tight labour market is
Yeah.
the reverse of the coin is supply difficulty in getting things built, for example.
That's right. That's correct. Yeah. So we've got that. That's one of the reasons which is sort of sustaining our CPI. So our forecast the forecast from the pre-election financial projection statement is for that to ease to 2.75 and 4.5, and then remain within the RBA target range for the whole period of the forecast. So just to compare our forecasts, or the PFPS forecast, with the national CPI, the basic profiles are very similar. You do see that national CPI forecast from the budget, Commonwealth Treasury and from the RBA does pick up in 25.6 to the top end of that range. So that's the headline CPI, but the RBA basically looks at their trimmed mean, which includes some volatile components, and that's certainly consistent with being in the middle of their target range, 2.6, 1.1 above their target, middle of their range. So that's obviously why they're comfortable with having reduced cutting the cash rate yesterday, and it's broadly consistent with our profile. Our profile is probably slightly higher in that short-term part. It's not much higher than the RBA trim mean, and that would be the housing component, would be the contributor. So productivity, just before I go to the actual productivity slide, I mean, there is obviously, you'd be aware there's a number of ways of measuring it. Labour productivity, which looks at the ratio of outputs to labour inputs, and multi-factor productivity, which looks at the ratio of output to a combination of labour and capital. Multi-factor is more comprehensive measure. So improvements in productivity come from a variety of sources, and it's worth bearing in mind that measured increase in labour productivity cannot be attributed solely to contributions from labour. It's not a complete measure because it does not take account of capital accumulation, and investment in capital can make substantial contributions to labour productivity. That said, the ABS does caution that in the short term, multi-factor productivity estimates are subject to data limitations, such as variations in capacity utilisation, economies of scale, reallocation of capital and labour, So effects from the reallocation of combining those, and measurement error. So it cautions that using measures such as multi-factor productivity should be used for analysis of long-term trends, and they're not really ideal for short-term fluctuations. So experimental estimates of labour and multi-factor productivity have been produced by the ABS. They were first produced at the state level in January 2018. Obviously, since that time, they're experimental. They really heavily emphasise that at the state level. And obviously, since they started publishing, which was only in 2018, you've had a period which things have been disrupted by COVID. And even the Productivity Commission's latest March quarter Productivity Quarterly Bulletin does talk about how COVID has impacted on productivity measured in that period, that it was going up and down due to different effects from COVID. So, yeah, I'm just saying that since they started this series, there has been that unusual impact. Probably we would have been less impacted than other states because shutdowns weren't as prevalent here as they were elsewhere east. But just to summarise what it's experimental estimates of and it's market sector productivity. It's not for the total economy, so doesn't include educational health or those, and I think general administration, public sector administration type functions. So the market sector productivity, if you look at multi-factor productivity, again, that's showing a decline in West Australian multi-factor productivity in 23-24, but I would caution again that the ABS does say that annual rates are something not to focus on, which is why I've included the past 5 years. The ABS actually talks about measuring it from peak to peak of the productivity cycle. Well, this isn't quite measuring that, but I've tried to do something that gives you at least a 5-year period of growth. So it's basically saying multi-factor productivity has been flat in WA, and in terms of labour productivity, it's been declining both last financial year, and modest declines over the past 5 years. Now, we do know that the mining sector, which almost accounts for more than well over 40% of our economy, close to 50% of the state economy, has had a negative productivity for a few years, so that will be dragging the West Australian productivity measure down. But we don't have, I haven't tried, and I'm not sure I would be able to anyway, to disentangle what that means by excluding it for WA. So I'm not in a position to provide advice on that, but other than if you've got zero multi-factor productivity over the last 5 years, that's probably going to be it would be positive if you take the mining industry out. And I think the mining industry is sufficiently... So nationally, the mining industry multi-factor productivity declined by 1.9% over the past 5 years. So you can see, given that's such a big part of the WA economy, you would have had positive growth in that measure. But beyond that, that's I'm just providing that as sort of summary statistics on productivity for the Commission to... Commission's information and noting that it's come out. Yep.
The RBA seems to still have the view that it's a risk to its outlook. If you look at its most recent publications, and certainly mentioned yesterday in the release in relation to the reduction in interest rates.
That's always going to be, it will, well, because it's been so low for a number of years, it will be a concern to them, because without productivity growth, you need productivity growth really to sustain wages growth over time if you're not going to have a significant adverse effects on inflation or unemployment.
I think the economic theory used to be that unless they keep pace with trendline productivity rates, then they'll be inflationary. That's the broad picture.
Yep.
But that's coloured by other things, of course,
Yes.
in the workings of the economy. But that seems to be the theoretical approach.
Yes, that's correct. Yeah. We've been through the forecast, but essentially we're expecting after a week, the domestic economy activity to ease, but still remaining relatively solid. GSP we're expecting to, the PFPS was expecting it to increase after a very weak year. Last year, there's some downside risk to both of those forecasts for 4-5, more modest for state foreign demand and more material for GSP. A slight employment, there's a slight downward risk to that 24/5 forecast, and unemployment rate, there's probably a slight upside risk. But beyond those risks, there's that set of forecasts. I mean, it's only in 24/5 we can even point those out, but beyond that, we're still looking at an economy which is growing, which has got solid employment growth, low unemployment rate historically, inflation within the RBA's comfort zone, wages stabilising at about 3%, and real wage growth across the period, with slightly slower population, but still growing by 1.7% by the end of the period. So the risk to what I've just described, obviously the most significant risk is to that global outlook. We just don't know how the US and our key trading partners might progress things. Obviously, I think the will would be to try and de-escalate if the US can get agreements with its trading partners, particularly China, and have then made some headway, having de-escalated from extremely high rates that have applied against each other. But we just don't know how that'll play out. The Chinese economy is weak. Largely that property market means the weak spending. Household spending is still subdued, and because it's reliant on exports for growth, that just means that there's a little bit more exposure there to what's happening with the trade situation. Consumer spending may be lower than we've anticipated if households become more cautious in response to elevated uncertainty, or if mortgage rates are maintained at higher rates than anticipated. So far, the RBA has been tracking the market sentiment, but let's see. The new residential construction market continues to face labour constraints, and that may actually constrain work done more than we forecast. And obviously the volatility in commodity prices and certainly may prompt some delays or postponement of some investment decisions, although we haven't been hearing of that for large projects at all. So, but it's always a risk. So that's the sort of outlook as far as this I can describe to you today.
Thank you very much indeed, Mr. Christmas. Are there any questions for Mr. Christmas?
No questions from us.
Nothing to you, Commissioner.
A question?
No, thank you.
You're off the hook, Mr.
Thanks, Jeff.
Thank you very much. That was very, very helpful indeed, as usual, and we're very grateful for your assistance. Thank you.
Thanks, Chief.
Mr. Trenchcombe, when you're ready, please.
Thank you, Chief Commissioner, and I'd just like to thank Mr. Christmas and his team again. We know they do a significant amount of work that goes into that, quite a lot of work that goes into those slides and the presentation, so we do thank you very much for presenting again this year. I'll now move on to the Minister's position. So, from the outset, the Minister acknowledges the critical importance of the state wage case. Many employees in the state jurisdiction are reliant on the Commission's determinations for their economic wellbeing, and it's these workers that are really at the centre of the wage setting considerations. While the needs of the low paid and the provision of fair wage outcomes are highly relevant, wage adjustments also need to be sustainable for employers, allowing small businesses and community organisations in the state system to remain viable. While not quantifying a specific figure, the Minister believes that any increase determined by the Commission in this year's proceedings should, as a minimum, meet the needs of the low paid and keep pace with changes in the cost of living. The Commission should also take into account the needs to encourage opportunities for employment and skills development. We note that in the 2024 state wage case decision, the Commission made an important decision to realign the state minimum wage to the C13 rate in the Metal Trades General Award, and that increased it to $918.60 per week. This followed the Fair Work Commission's realignment of the national minimum wage the previous year. So as a result of that realignment, the state minimum wage went from being almost $20 a week lower than the national minimum wage to being just marginally higher. This outcome was welcomed by the West Australian Government as it closed a gap that had opened up temporarily between the two jurisdictions. To preserve the integrity of the state system and to ensure it remains fair and relevant for employers and employees, the Minister submits it's desirable that any increase determined by the Commission this year not be less than that awarded in the annual wage review. There's merit in maintaining a degree of harmony in wage adjustments in the state and national systems to provide equity and fairness for West Australian employers and employees. Having restored some parity between the amounts payable to the lowest paid in both jurisdictions, we say it would be undesirable for state system employees to then receive an increase this year that's markedly lower than that awarded nationally, which would potentially undermine some of the benefits that flowed from the realignment last year. Another consideration is the need to ensure that rates of pay in state awards don't fall significantly behind those in the national system. We note that in the national jurisdiction, many of the skilled classifications in modern awards are now higher than those in equivalent state awards. And that's come about through a variety of factors. In some cases, the lack of maintenance of the skill-based classifications in some state awards, but also some recent work value determinations at the national level. Just to give a few examples, the minimum weekly wage for a level 4 social and community services worker at the first pay point is $1,636.93 in the national system, and it's $1,482.40 in the state system. That's including the equal remuneration order for both awards. The base weekly wage for a full-time Certificate 4 qualified pharmacy assistant is $1,074.70 in the national system, and it's $971.70 in the state system. And for a qualified dental assistant, it's somewhere between $1,032.30 and $1,067.30 per week in the national system, depending on the level of responsibility. In the state system, for dental assistants, it's $918.60. So obviously that's not an issue that can be addressed fully in the state wage case. We just make that point that the margin between the wages for skilled classifications would widen further if the if there was to be a lower increase in the state system. And obviously there's still many skill shortages that are evident in a range of industries, as we've heard this morning from Mr Christmas's presentation. So it's desirable that a fair and sustainable increase be afforded to minimum pay rates in the state system. In relation to the economy and labour market, the Minister notes the West Australian economy and labour market have continued to display considerable resilience, with low levels of unemployment, solid full-time employment growth, buoyant household consumption, and ongoing population growth. As demonstrated in much of the data presented by Mr Christmas this morning, most economic and labour market indices remain above pre-pandemic levels. And the state's domestic economy in particular has been robust. While WA's economy and labour market have remained strong, the state's economic outlook is subject to several potential risks, which were also discussed this morning, in particular the significant escalation in trade protectionism and tariffs, which is rapidly evolving. Notwithstanding these risks, Western Australia has performed very strongly, and the state leads the nation on a variety of different indices. And indeed, we've regained the title of the number one state in the ComSec State of the States report. While WA has delivered strong economic outcomes, the Minister still acknowledges that cost of living pressures have been challenging for many households, in particular salary and wage earning households. And those people are more likely to have mortgages and loan repayments to service or rents to pay. Over the past year, Western Australian property prices and rents have continued to increase. And while the state's housing market has had a modest softening in recent months, it still remains pretty tight. As some of the other parties have also noted in their submissions, increases to a number of non-discretionary expenses, such as health, education and insurance, have also exceeded the total per CPI over the last 12 months. The Minister does acknowledge that rising expenses are also an impost for employers, and higher input costs also create challenges for some businesses. So to help address some of the cost of living pressures, the state and federal governments have implemented a range of initiatives to help ease the financial burden, and they've introduced a range of things such as electricity credits for both for businesses and households, discounted public transport, student assisted payments, utility hardship concessions, etc. While these initiatives are welcome and important, government cost of living measures are still not a substitute for fair and regular adjustments to minimum rates of pay, which still remain essential for the financial well-being of workers. When looking at wages, the Minister notes the wages growth has eased over the past year, and as we saw from this morning's presentation, and the wage price index has declined from growth of 4.2% in the year to March 2024, down to 3.7% in the year to March 2025. The latest projection from Treasury is for wages growth to grow by 3.75% in 24-25, and we're tracking pretty close to that at the moment, before easing slightly to 3.5% in the next financial year and 3% in the 2 years after that. While inflation's also eased considerably over the last 2 years, and wages growth is projected to be positive from this financial year onwards, the significantly higher rates of inflation recently experienced have put pressure on many WA households. Minimum and award wage earners are a particularly vulnerable cohort, and they often have little in reserve to meet unexpected expenses or emergencies. The Minister notes the most recent seasonally adjusted estimate for average weekly ordinary time earnings, or AWOT, is now about $2,156.80 per week, or a little over $112,000 per annum. At the same time, the state minimum wage is a little under $48,000 per annum, and the C10 classification, that is the skilled tradesperson's classification, is a little over $53,000 per annum. As outlined in the Minister's primary submission, the most recent data indicates that award-reliant employees in WA have much lower average earnings than those employed on other pay-setting arrangements, and even lower average earnings than award-reliant employees nationally. And that may seem a little bit surprising, although it's perhaps not when you consider that the WA has long had a higher Gini coefficient when it comes to wage distribution. So the importance of a fair and sustainable increase in award wages is therefore paramount. In relation to coverage of the state wage case, the Minister's written submission included some breakdowns of the most commonly accessed award summaries produced by the department.
Yes.
And it's notable that the top few awards actually accounted for a substantial portion of the total downloads. And we note that while the number of award summary downloads is not a direct proxy for the number of employees covered under particular state awards, and I confess to being guilty of contributing to some of those downloads, this information...
Will apply a significant discount.
Yes. At least the good thing is I probably have discounted it evenly across all of those summaries, so it probably washes out in the end. Nonetheless, this information does provide some anecdotal evidence as to the industries that are most affected by the state wage case. The data in the Minister's submission suggests that a relatively small number of state awards account for the bulk of private sector and local government award coverage in the state system. And a similar observation has been observed in the national jurisdiction, where researchers found that the vast majority of award-reliant employees are employed under a small number of national modern awards. The Minister notes that in the last year, significant progress has been made outside of the state wage case to update a number of the key state awards and to expand their scope. And this work's vitally important to ensure the award system remains relevant and accessible for employers and employees in the state jurisdiction, and the state wage case process complements this work. The Minister's written submission also includes detail on apprenticeship and traineeship commencements and numbers in training. The information regarding training arrangements in Western Australia has been provided by the Department of Training and Workforce Development, and the Minister thanks the Department for providing that information. As outlined in the Minister's written submission, apprenticeship commencements remain largely static in 2024, while traineeship commencements declined. So traineeship commencements have declined by a fair bit in the last 2 years, following the withdrawal of certain Commonwealth Government wage subsidy incentives in 2022. So the total number of West Australians engaged in training declined by around 2,000 persons in 2024. However, this was entirely due to the fall in the number of people engaged in traineeships. The total number of people currently undertaking apprenticeships rose marginally in 2024. And that's the 7th year in a row that total apprenticeship numbers have increased. And we do, when we look at the breakdown of the actual industries, a number of those increased apprenticeship numbers are in the building trades, which will be good in some of the years coming. Western Australia is still experiencing a skill shortage in a variety of sectors, however, including the construction trades, health and aged care, tourism and hospitality, and agriculture. A fair wage adjustment for state award wages will flow through to the rates of pay for apprentices and trainees, which is important for facilitating the uptake of vocational education and training in Western Australia. And an updated schedule of the registered training packages and the industry skill levels was appended to the Minister's primary submission for use.
Yes, thank you for that.
Thank you. In this year's state wage order. As part of this year's proceedings, the Commission and Court session indicated that it would also like to hear from the parties in relation to Clause 8B of the State Wage Order, and that sets out the adjustment of trainee wages following any increase in the State Wage Order. So at present, the State Wage Order provides that the highest rate for each skill level highest rates for each skill level are increased by 80% of the arbitrated safety net adjustment. However, in practice, this only occurs when there's a flat dollar increase determined by the Commission. In the case of any percentage increase being awarded, the long-standing practice has been to adjust the highest rates for each skill level by the actual percentage and not by 80%.
Yes.
So to enable the State Wage Order to reflect the long-standing practice, the Section 50 parties conferred and agreed on a proposed update to the wording in Clause 8B, and that was included in the Minister's written submission.
Yes, thank you.
I thank Unions WA for reaching out and facilitating some discussion on that. In terms of the date of effect, the Minister submits that any increase awarded in this year's state wage case should take effect from the first pay period on or after 1 July 2025, in line with normal conventions. Before finishing, I'll just briefly touch on the submissions of some of the other parties participating in the state wage case. For the CCIWA, in its submission, the CCIWA proposes the Commission grant a 2.5% increase to the state minimum wage and presumably state award wages. The Minister notes that a 2.5% increase would effectively amount to a real wage decline for minimum and award wage earners in WA. This would add further pressure to many working households, particularly given cost of living pressures they've experienced in recent years. So the Minister respectfully submits that a below inflation increase would not adequately consider the needs of the low paid and contribute to improved living standards. In its submission, the CCI contends that the increases to certain allowances and state awards represent an improvement in the overall wages and conditions of employment, and that any increase to the state minimum wage should be moderated because of this. In regard to the allowances contained in state awards, a small handful of allowances out of many thousands operating across the state system have recently been updated as part of award review processes. However, it's important to note that most of these allowances had been frozen for many years, and the award updating processes simply brought those allowances up to an amount that represents their contemporary value. So we don't consider that to be an enhancement of conditions of employment in the commonly understood sense, but rather an adjustment process. So the Minister contends it wouldn't be appropriate to discount the level of any across-the-board increase for state system workers because of the indexation of a few allowances to reflect present-day values. In terms of business operating conditions, the CCI's initial submission also highlights the difficult operating conditions that WA businesses currently face, and submits. It also discussed the number of business failures across the state over the last 12 months. And it submits that the data shows a considerable rise in the number of business failures, and suggests that the sectors affected by the state wage case aren't as positive as suggested. It also contends it's important for the Commission to consider the impact of high interest rates, higher input prices and higher labour costs on business. Certainly the Minister acknowledges that business costs are a relevant factor in determining the capacity of employers to afford increased wages. However, in regards to insolvencies, the Minister notes that actually yesterday the Federal Government provided a response to a question on notice from the Fair Work Commission regarding an increase in business insolvencies at the national level. And in response to this question, the Federal Government noted that insolvency levels actually remain below the long-term historical average as a proportion of total companies. It also noted that the level of insolvencies are not a reliable indicator of business conditions, given insolvency activity can reflect other factors. And business insolvency doesn't necessarily equate to business closure, as small businesses entering corporate insolvency are increasingly using the small business restructuring process to remain in business. I think Unions WA made a similar point in its submission as well. The Minister also notes yesterday, as was discussed in this morning's presentation, that yesterday the Reserve Bank lowered the official cash rate by a further 25 basis points, or 0.25%, and that followed a 0.25% reduction in February this year. And markets are strongly pricing in further rate cuts this year, which should hopefully also bring some relief to businesses and households servicing their debts. Unions WA is seeking an increase to the state minimum wage of $41.34 per week and a 4.5% increase to award wages. Just on a very technical point, the Minister noted that consistent with the rounding formulas, minimum weekly rates of pay are rounded to the nearest 10 cents, so that would effectively mean an increase of $41.30 to the state minimum wage rather than $41.34. And rates of pay in state awards would also round to the nearest 10 cents. Unions WA's submission reproduces material demonstrating many essential and non-discretionary expenses that have been rising faster than total CPI. The Minister acknowledges that living costs for many minimum and award-reliant workers have risen faster than for the community as a whole. And that's also borne out by the Employee Living Cost Index, which is only available at the national level, unfortunately, but that does show employee households as having somewhat higher living cost increases than all CPI. And that's mainly due, or a large part of that is due to the fact that wage and salary earners are more likely to have mortgage and rent payments to service. So that's a relevant consideration for the Commission to consider. Unions WA submission also notes the high gender pay gap in WA and includes some of the same data regarding gender pay disparity that was referenced in the Minister's submission. So the Minister agrees that female employees are more likely to be reliant on minimum and award wages, and notes they're also more likely to be low-paid award-reliant employees. While the state wage case can only play a limited role in reducing gender pay inequality, the fact that women are more likely to be award-reliant and low-paid reiterates the importance of a fair and sustainable increase being awarded in this year's proceedings. And as with Unions WA, WACOS proposes a 4.5% increase in the state minimum wage, although it hasn't specifically proposed a particular increase for other award wages. The Minister acknowledges the detailed information provided by WACOS regarding living costs, inequality and poverty amongst vulnerable members of the community, and the use of case studies outlining the lived experience of low-wage earners. That does present some valuable real-world examples of issues affecting people. So that's relevant background information for the for the Commission's consideration in the state wage case. And the West Australian Local Government Association also put in a submission again this year in supporting increases that balance the need for fair wages with the requirements of local governments to carefully manage their budgets in the interest of their communities. The Minister notes the information provided by WALGA regarding local government finances and the capacity of local government authorities to pay higher wages. This information is a relevant consideration, as is the need for local government workers reliant on award wages to receive a fair wage increase as part of this year's proceedings. So in conclusion, the state wage case proceedings are an important part of the industrial relations framework. The Minister supports the Commission delivering a fair and sustainable increase to minimum and award wages, and one that protects West Australian workers and supports growth and opportunity for local business. Any such increase should, as a minimum, keep pace with changes in the cost of living, while also being sustainable. And to preserve the integrity of the state system, the Minister also submits it's desirable that any increase determined by the Commission not be less than that awarded in this year's annual wage review. The Minister has no further substantive information for these proceedings, but reserves the right to respond to matters raised in the presentations of the other parties. If it pleases the Commission and Court session, that concludes the Minister's submission.
Thank you very much, Mr. Ritchie. Thank you very much indeed, Mr. Ritchie, for those submissions.
Thank you.
Now, Mr. Harding, would you like to go first?
Yes. May it please the Commission in Court. I, Mr. Harding, appear on behalf of the Chamber of Commerce and Industry, Western Australia, alongside my colleague, Mr. Collins, who today, if there's any substantive questions about productivity that get into the detail, will be able to help answer as our senior economist. CCIWA primarily relies on our written submissions that have been tabled and shared with all parties. However, I'll take the opportunity today to summarise our position. Some of our economic insights referred to in my contribution today, as well as the two submissions, are produced in-house. Every quarter, we run our business confidence survey. This is the longest running and most comprehensive business survey in WA. We survey WA businesses of all sizes and sectors across the state on a quarterly basis. We look at business confidence levels and the level of profitability, as well as exploring key concerns facing businesses, such as labour costs, supply chains, pressures and skill shortages. For our March 25 quarter survey, we had 632 respondents. Of the respondents, approximately 40% came from industries most represented in the state system. More than 50% of those who respond to the survey have less than 20 staff. As a point of comparison, the NAB Small Business Survey has about 100 respondents from WA. CCIWA contends that the most appropriate and economically responsible increase to the state minimum wage and award wages is 2.5%, with a total compensation increase of 3% when including the statutory rise in superannuation. There are several reasons for this position, which I'll take you through now. Firstly, Chief Commissioner and Commissioners, we must look at the state of the global economy. The global economy has been more resilient than anticipated, considering the number of headwinds and external shocks that have occurred through the global system. However, significant concerns remain, and there is considerable uncertainty going forward. CEA Matt Comron said quite succinctly that there is a heightened risk to the global economy from geopolitical and macroeconomic uncertainty, which can slow the domestic economy. The OECD expects global economy to continue growing, however, at lower rates. They forecast global growth of 3.1% and 3% in 2025 and 2026 respectively. This is also below the long-run average and is attributed to sluggish productivity and global geo-economic fragmentation. This geo-economic fragmentation currently underway poses significant risks to both growth and inflation, both here and globally. In particular, the sweeping tariffs recently announced by the US on almost every economy in the world is threatening a global economic slowdown as supply chains are forced to reshuffle. Australia, and indeed Western Australia, are not immune to these impacts of these tariffs. While having a limited direct impact, Australia has significant indirect exposure through the effect tariffs will have on our trading partners, most notably China. Australia's major trading partner, China, is going through itself a prolonged economic slowdown, the likes of which have not been seen since the 1990s. China has been the most heavily impacted by the US tariff agenda, initially facing a tariff rate of 145% on all goods from the 12th of April 2025. On the 12th of May, China and the US agreed to a 90-day reduction in the tariffs between them. However, beyond that 90-day reduction, at this point, US tariffs on China will resume at 145%, and China's tariffs on US goods resume at 125%. As a result, many commentators have significantly downgraded their forecast for China's economic growth. Vanguard, for example, has downgraded their forecast from 4.5% to just above 4%. This is particularly relevant for Western Australia, as approximately half of our exports are sent to China every year. Any slowdown in China will likely most be felt in WA, as weaker economic growth results in weaker demand for WA's exports. Alongside tariff risks, there are significant structural issues in China threatening its economic outlook, including the persistent downturn in its property market, high levels of debt, and a declining population. China's economic troubles have a direct impact on WA and particularly our mining sector. Importantly, 85% of WA's iron ore exports, a quarter of which are currently used in China's property sector. Recent data has shown that real estate investment in China continues to contract, falling 9.5% over the year to February 2025. Floor space under construction has also fallen 9.1% over the same period and is now 24.8% lower than the end of 2021. This significant uncertainty surrounding the impacts of the tariffs on China's export sector, combined with persistent weakness in its property sector, mean caution must be taken when assessing China's economic outlook. Given WA's reliance on China's demand for its exports, the health of China's economy should be considered a key risk to the economic outlook for WA and, in turn, the strength of WA businesses. Chief Commissioner and Commissioners, I'll just now touch on the national economy. Australia's economy has softened over the past year, according to the ABS. The economy grew just 1.3% over the year to December 2024, lower than the 1.5% growth of 2023. These figures are also below the long-run average of 2.7%, as higher interest rates and the last of the main inflationary pressures dampen economic activity. Public spending nationally has been the primary driver of growth, with public consumption rising 5.1% and public investment lifting 8.1% over 2024. In contrast, household consumption only rose 0.7% and business investment fell 0.1%, both of which have weighed on growth. Commissioners, this is not a sustainable formula for growth for the Australian economy, as it continually is heavily financed by significant cash deficits by both states and federal governments, and will weigh on Australians in the future either through higher taxation or reduced services. Encouragingly, the RBA expects economic activity to improve in 2025 and 2026, alongside real wage growth supporting consumption. This has coincided with the easing of interest rates, with now 2 rate cuts since February. Producer prices, which are measured by the Producer Price Index, continue to remain elevated, however, and are increasing at a greater rate than they are being faced by consumers, rising 3.7% over the year to March. The ABS notes the increase stems from labour shortages, higher input prices associated with higher labour costs, and higher operating costs in service industries. This continues to push up the cost of doing business in Australia, as well as Western Australia, making it much harder for small and family-run businesses to weather unsustainable wage increases. For consumers, the outlook is much more positive. Inflation continues to subside nationally, which is now at 2.4% over the year to March. Trim mean inflation, which is the RBA's primary inflation measure, is also now within the RBA's target band at 2.9% over the year to March. The RBA has, in their recent statement of monetary policy, revised inflation to remain within the target band over the forecast period, with 2.6% to the June 2025 quarter. While this is within target band, it is still above the midpoint of the RBA's targeted range, suggesting the RBA will continue to remain cautious about the outlook and the upside risk to inflation. This suggests that the fight against inflation, while positive, has not yet been won. In assessing risks to the inflation outlook, the RBA has also identified low levels of productivity growth as one of the 3 most prominent risks underlying high inflation gaining traction once again. The impact of this is significant, as inflation is regressive, meaning it will impact those on the lowest incomes the most and erode whatever benefits come from large nominal wage increases. Chief Commissioner and Commissioners, one of the most important aspects that CCIWA contends should be considered by the Commission is this issue of productivity. Productivity growth is important because it enables rising living standards and is needed for real wages growth to be consistent with stable inflation over the medium term. Ultimately, increases in wages are not sustainable without long-term gains in productivity growth. If labour productivity increases, unit labour costs will decline, where unit labour costs are the additional cost of an extra unit of output. Unit labour costs are a critical measure as they affect firms' pricing decisions and therefore the overall rate of inflation. Commissioners, unit labour costs have risen 5.3% over the year to December 2024 nationally. This is significantly higher than the pre-pandemic average of 1.8%, resulting from higher nominal wages growth with subdued productivity. Productivity in Australia remains weak, with the RBA yesterday releasing that labour productivity has declined 1.5% over the year to December 2024. As a result, productivity levels have returned to the same levels as they were in 2015. That is 10 years of stagnating productivity within Australia. Commissioner, this is a significant issue and is getting worse. During 2024's annual wage review, the Fair Work Commission made a decision to limit the increase of the rise of the national minimum wage and award wages as a result of the lagging productivity. In 2024, the Commission said this poor productivity performance was a moderating factor in the determination of the quantum of minimum wage increases awarded. Right now, the nation's labour productivity has gone backward once again since the full bench made that statement. Chief Commissioner and Commissioners, I'll now just touch on WA's economy and its outlook. While we have been extremely well positioned in Western Australia, the WA economy has continued to perform strongly. This is being driven by solid but slowing household consumption, rising business investment from large-scale investment projects, and significant government investment and consumption. Lastly, government investment continues to drive a large proportion of the state's economic growth. The state government asset investment program has seen a surge in public investment activity, rising 17.6% over 2024. Asset investment is expected to decrease over the forward estimates, but is still at elevated levels as the program continues to be rolled out. However, extensive government expenditure is not a sustainable pathway for WA's economy to continue growing. Also, as noted in the WA government's budget, inflation is forecasted to decline further, falling to 2.75% over 2024-25 and remaining at that level in 25-26. While we have been incredibly lucky, WA's economy continues to also be overly reliant on a single industry for our economic prosperity, with the mining sector comprising nearly half of the state's gross value. This over-reliance on the mining sector means that WA's economy often follows a boom and bust cycle. When commodity demand is strong and prices are high, economic activity typically picks up, and vice versa. This is particularly the case for iron ore and LNG, which combined make up almost 3/4 of WA's exports. As you can see, our state's robustness is largely due to the significance and strength of the mining industry, with that economic prosperity not always shared across the industry sectors. This is why we caution the use of the headline figures in determining whether businesses can afford a significant rise. Both short-term and long-term business confidence in WA has improved, however, it remained below levels experienced prior to COVID. Nearly 70% of businesses involved in our March survey indicated rising operating costs as the biggest barrier to growing their business over the coming year. While reducing, interest rates continue to weigh heavily on businesses. Just as higher interest rates increase mortgage repayments for households, they too impact the borrowing costs for businesses. This is also reflected in the RBA's September 2024 Financial Stability Review, which stated the impact of higher interest rates tend to be larger for smaller businesses. They are also the businesses most likely to be captured in the state industrial relations system. Commissioners, all of this has continued to put sustained pressure on business, with the rate of business failure continuing to grow. CCIWA finds this deeply concerning.
Presumably with the RBA seemingly on a pathway to loosening monetary policy, that may have some positive effects for small business, which are, of course, may have mortgages linked to their businesses to fund their business expansion. I know homes may be mortgaged to the businesses. So that will have a positive effect for them as well, won't it, as well as consumers?
Yes, it will. Obviously, I will caveat with the fact that if the banks do pass it on, though I think all four major banks have passed it on as of today, but that is obviously predicated on that. However, we know that most business lending is primarily, particularly for small businesses, is by household mortgages. And I can, during the break, make sure we can get some of that data.
I think there was some material available last year as well.
I believe so, yeah.
But I just wanted to make that point because there will be some benefits for the small business sector as the RBA moves down this path, I think.
That is true, but obviously it's just one component of the rising costs as well.
Yes.
Thanks. Commissioners, all this has continued to put sustained pressure on businesses, with the rate of business failure continuing to grow. In WA, we have seen 30% more businesses enter administration over the last 12 months to March 2025 when compared to the year prior. Over the last 2 years, we've seen a 66% increase as more businesses enter administration. This is expected to trend higher as businesses pressure on operating margins continue. The businesses failing to include those most likely covered in the state industrial relations system. For example, the food services industry has seen a 21% jump of businesses going into administration. The construction industry has seen a 19% jump. The healthcare and social assistance industry has seen a 37% jump, and the retail industry has seen a 4% jump. When looking at these rates of administration, we can broadly indicate that the overall capacity for businesses to pay continues to be restricted. As the RBA has noted as well in the September 24 Financial Stability Review, there is an increasing share of firms experiencing challenging conditions. This is particularly the case in discretionary sectors as households have pulled back on consumption, which has led to more significant declines in profitability in the retail and hospitality industries. This review reinforces the empirical data mentioned earlier. Businesses in WA and across the country more broadly continue to face significant uncertainty and cost pressures. These all continue to result in greater business failures and reduced profitability, ultimately a reduced capacity to cover the high wage increases. CCI therefore would submit that the Commission should consider the comments of the RBA and recent asset data that shows businesses continue to have a restricted capacity to pay. Just on the next, I'll touch on a system of fair wages and conditions, Chief Commissioner and Commissioners. We contend that it is important to consider other increases that impact the entire remuneration package, which is the direct cost to employers. For example, effective of 1 July 2025, statutory superannuation contributions will increase by 0.5% to a high of 12%. There has also been recent changes to allowances and variations that are occurring for the state awards, which have been undertaken by the Commission. While we accept that it is bringing them up to what the levels are currently, it is still a direct substantial increase from where they were, which is a direct cost on their business, particularly those that are likely to be smaller. This also includes the recent general order, which will now make all state awards have a mandatory 25% casual loading. We contend that these must be considered as part of the state wage case and considered by the Commission and Court, as they will have a direct impact on the cost to businesses and do make up the total cost of employment. Importantly as well, the wage price index shows wages in WA grew by 3.7% to March 2025 compared to the national growth of 3.4%. This is also the highest rate of wages growth of all states. We also note for a system of fair wages conditions, businesses must continue to be profitable. Currently, profit margins for businesses, particularly SMEs, remain tight and business failures are rising. And I'll just make some final comments around meeting the needs of the low paid. State minimum wage and state award wage earners received a real wage increase over the last 2024 state wage case. Using the state budget's assumptions, the state minimum wage increased by 3.64% when compared to the rate of inflation of 2.75% over this financial year. Since 2021-2022, real wages growth for those reliant on the state minimum wage have grown in real terms to 4.8%, while the rest of WA has fallen over that same period by just 0.4%. While looking at it over the past 4 years, those reliant on the state minimum wage have not gone backwards, but have continued to improve, especially when compared to the rest of WA. It is also important to note, as the Commission has stated itself in previous cases, the state minimum wage alone cannot address all the needs of the low paid, and as such, tax and transfer payments have a significant role in providing targeted relief to the low paid. As Mr Christmas noted, the state government and the federal government are providing cost of living relief for many of those who are low paid. This, through a varied approach, is occurring, which includes greater social welfare benefits like rental assistance payments and other measures including income tax changes, which are directed at those on the lowest income levels. We believe these factors should be considered by the Commission when determining the state minimum wage. I'd just like to briefly summarise our position and finish off. CCIWA holds a position that a 2.5% plus a 0.5% superannuation increase is the most economically responsible course to support the low paid while not being inflationary or detrimental to WA businesses. Our reasoning is simple and clear. The economic environment for large increases of the state minimum wage is not there. The fundamental of the WA economy is being challenged by a myriad of local, national and international factors. Our largest trading partner is currently caught in the large global push away from free trade and the rise of protectionism, putting us at significant risk. Their own economic woes are a cause of concern for WA. Domestically, labour productivity continues to go backwards, with workplaces in Australia continue to be less and less productive every year. We continue to see concerns raised time and time again of business failures, suggesting the headline figures being experienced do not marry up to the reality of operating in Western Australia and Australia. For these reasons, we suggest that a 2.5% increase to a total of 3% when factoring in super will proportionately provide greater benefit to the low-paid workers, while at the same time minimising any inflationary pressures or business insolvencies that may occur with a large percentage increase. This concludes my remarks today. Thank you, Chief Commissioners and Commissioner.
Thank you very much indeed, Mr Harding.
I think it's put against CCI that in relation to the submission that increases in allowances as part of award reviews are just bringing things up to date. But I guess to the extent that those award reviews involved changes to the scope of an award, for instance, the Hair and Beauty Award, bringing in the beauty industry, those are allowances that never previously applied that now apply.
I will admit I'm not well versed on the Hair and Beauty Award, but I would, yes, that is the case. The one that would come to my mind was, it was last year, is the shop warehouse award, where there was a substantial increase as a result of using the calculation system that is in the national award, which again brought it up to the current standards, but was a substantial increase from where it was. And while we accept that it is bringing up to today's standard, it is still a direct cost on the employer. They're the ones ultimately paying it. They've gone from being hypothetical of $4 or $15 up to a $20 or $30 or $40 increase. It's still a direct cost to the employer, even if it is bringing them in line with the current costs as they're meant to be now.
Thank you very much indeed, Mr Harding. Are we going to hear from Mr Collins or?
No, Chief Commissioner.
All right, thank you very much. Now, you, Ms WA, please, Mr Steadman.
Chief Commissioner, Senior Commissioner. We primarily rely on our written submissions as well as those submissions in response, Chief Commissioner. We'll supplement those today with oral submissions. Ms Hendon, Ricky Hendon, who's the Secretary of Unions WA, and today representing over 30 affiliated unions and well over 150,000 workers in Western Australia, will make some brief opening submissions, Chief Commissioner, and then we'll hand it over to Mr Hanson, who will speak to our written submissions and take some questions if there's details around that.
Indeed. Very good.
It should be done by 1 o'clock, I would
All
say.
right. Well, that's very good to hear. We don't want to rush you at all.
You won't rush. I'll hand it over to Ms.
Thank you very much indeed. Ms Hendon.
Thank you, Chief Commissioner. Senior Commissioner, Western Australians live in the richest state in one of the richest countries in the world. It is reasonable to expect that every full-time worker in WA, including those on the state minimum wage and state award wages, can afford to put a roof over their heads, food on the table, and live a life that reflects their innate human dignity. This expectation is reflected in the Western Australian Industrial Relations Act, specifically Section 50A3, which states that the Western Australian Industrial Relations Commission shall take into consideration, amongst other things, the need to meet the needs of the low paid, provide fair wage standards in the context of living standards generally prevailing in the community, and contribute to improved living standards for employees. Chief Commissioner, Senior Commissioner and Commissioner, I will contribute to Unions WA's oral submissions today by examining the extent to which these expectations reflect the present reality for state minimum wage earners in Western Australia. Let's start with housing. Housing is more than just a roof over our heads. It is the foundation of stability, security and opportunity. Yet for many hardworking people earning the state's minimum wage, the dream of affordable housing feels increasingly out of reach. Perth, once known for its relatively affordable living conditions, has now become one of the least affordable capital cities in Australia for renters. CoreLogic's most recent quarterly rental review reported that Perth continues to record the largest annual rental increase amongst the capitals, up 6.3%. Median weekly rent in Perth has surged to $710 per week, making it the most expensive city in Australia in which to rent after Sydney. The vast majority of minimum wage workers are forced to spend more than 30% of their income on rent, pushing them into housing stress. For a single worker earning the state minimum wage, median house rents would consume an astronomical 74.03% of their wage, and median unit rents 70.76%, based on figures current as of April 2025. This means that securing a safe and stable home is no longer just difficult, it is nearly impossible. Many are left with no choice but to share overcrowded accommodations, live in insecure housing and or poor quality housing that places their health and safety at risk. Some face the heartbreaking reality of homelessness despite working tirelessly to make ends meet. Unions WA acknowledges the case studies highlighted in the written submissions by WACOS. The themes within them are consistent with the stories WA unions report hearing from workers under their coverage. Stories of workers forced to sleep in cars because they have been unable to secure an affordable home at the end of their lease. Stories of workers forced to move back in with their parents, with their children in tow because they can no longer afford their rent after yet another increase. Next, let's talk about putting food on the table. The affordability of food should not be a privilege, it should be a right. But according to Foodbank's latest hunger report released in October last year, food insecurity is a reality for approximately 370,000 or 34% of WA households, with low-income households identified at greater risk than the general population. And it is no wonder. As highlighted in Unions WA's written submission, the ACCC Supermarket Inquiry final report, released on the 21st of March this year, found that over the last 5 years, grocery prices have risen by more than other goods and services, with wages not keeping pace with grocery inflation. A trip to the supermarket is no longer just a routine errand, it's a financial balancing act. Prices for fresh produce, dairy and meat have surged, and with what little is left in their budgets after paying for rent, many workers on the state minimum wage find themselves forced to make tough choices at the checkout. Buy quality or quantity. Risk the nutrition of growing children or cut back the size of adult meals. Skip a meal altogether to make ends meet. These are the real and impossible decisions which many low-paid workers tell their unions they're forced to make, at the cost of their health and well-being. When a worker cannot reliably afford shelter that is safe and food that is nourishing, let alone their other non-discretionary expenses like utility bills, transport, education and medical costs, it's easy to reduce the frame by which we assess the adequacy of their wages to one of facilitating survival, but what of dignity? Section 50A3(3) requires consideration be given to the need to provide fair wage standards in the context of living standards generally prevailing in the community. Australia ranks highly on both the OECD Better Life Index and UN Human Development Index. Western Australians overall enjoy a good standard of living and expect a fair day's pay for a fair day's work to deliver them more than a hand-to-mouth existence. For most, it delivers a dignified standard of living that affords them the capacity not just to keep their head above water, but to enjoy life, establish social connections, and participate fully in their communities. Financial constraints can limit participation in social activities, cultural events and recreational activities, which are essential for mental well-being and community engagement. This is reflected in reports from unions of low-paid workers who are unable to enrol their children in sport or pay for them to participate in special activities like going to the movies with their friends during the school holidays. The cost barrier to social inclusion experienced by low-paid workers exacerbates their challenges, limits their networks of support, and impacts their capacity to realise their full potential. The capacity of state minimum wage and award-reliant workers to put a roof over their heads, food on the table, and live a life that reflects their innate dignity hangs in the balance. Chief Commissioner, Senior Commissioner and Commissioner, these workers are fortunate that you are empowered to improve their living standards. Your decision in this year's state wage case has the potential to make a real significant difference in their lives by awarding an increase that improves their security, stability, health and social wellbeing. Unions WA contends that the Commission should make a substantial real wage increase to the state minimum wage of $41.34 per week, with commensurate increases of 4.5% for state award-reliant workers. This is needed to address both the sustained increases in living costs I have described and the real wage decline my colleague Mr Hanson will now speak to in more detail. Thank you.
Thank you very much indeed, Ms. Hunter. Mr Hanson.
Thank you, Chief Commissioner. Even as growth in the Consumer Price Index moderates, the cumulative impact of significant and sustained price increases has eroded the purchasing power of Western Australian workers. Despite the overall strength and resilience of the Western Australian economy, the cost of living remains a pronounced pressure on award-reliant workers. It is particularly acute for those on lower incomes because of the extent to which increases in the prices of essentials have contributed to the decline in real wages. Using Perth's CPI and previous state wage orders, we charted the trajectory of real award wages as presented on page 20 of our initial submissions. What is apparent is that real award wages show a decline. Real award wages, as measured using Perth's CPI, shows a decline of 3.2% from their peak in June 2020. An even greater decline of 4.92% from June 2020 is observed when the electricity sub-index is excluded. Conducting that exercise for the state minimum wage reveals a different trajectory due to the realignment from the C14 to C13 levels last year. When the electricity sub-index is excluded from Perth's CPI, however, it is apparent that even following that realignment, real wage decline of 2.14% has occurred from the June 2020 high point. In our initial submission, we also considered real wage growth through deflating the stage wage case decisions by CPI at the time the decisions were made. Examining each decision from 2021, it is clear that increases in award rates have been outstripped by Perth CPI in every year except 2023, both when electricity is included and excluded. The cumulative result is a real wage decline of 4.65% and 4.95% when electricity is excluded over that period. Doing the same with the state minimum wage, we found a real wage decline of 1.66% and 1.96% when electricity is excluded over that period. This was driven by Perth CPI, including and excluding electricity, outstripping state minimum wage increases in 2021 and 2022. Unions WA recognises that CCI WA has taken a different approach to measuring real wages than we did in our initial submissions. We consider their approach to be analytically justifiable for the reasons outlined in our submissions in reply. However, we contend that by setting 2021-22 as the base year, it misses the commencement of the period where we have seen significant inflationary increases. As such, we consider it more illustrative when taking this approach to set 2020-21 as the base year. On that basis, cumulative state minimum wage growth over the period would be just 0.89%. Given the realignment that occurred as part of last year's decision, which is responsible for pushing that growth into positive territory at all on this measure, it is clear that workers on award levels above C13 have not experienced real wage growth. What these different measures indicate is despite real increases for the state minimum wage in the last two decisions, and in 2023 for award wages, state minimum wage reliant workers have at best seen only minimal real wage growth, while award reliant workers at other levels have experienced a real wage decline. Unions WA submits that given the economic and business conditions of Western Australia, this year's state wage determination is the appropriate opportunity to make substantial progress in repairing the real value of minimum award wages. Unions WA also submits that the state wage order has an important role to play in addressing the gender pay gap. While we would certainly not contend that award wage increases alone are sufficient to overcome it, the significant overrepresentation of women workers on award wages means that increases in the minimum and award wages provide a greater benefit to women workers. This is not unique to Western Australia or Australian labour markets, and there has been substantial international research, as referenced in our submissions, across a variety of different labour markets to demonstrate the direct and significant impacts that increases in minimum award wages have on the gender pay gap. On the subject of productivity, Unions WA reiterates the position put forward in our written submissions that the national GDP per hour worked statistics do not adequately reflect underlying productivity trends in the area of the economy that are relevant to the state wage case, resulting in a level of concern about wage growth that is not supported by the data. As discussed in our written submissions, mining, as mentioned by Mr. Christmas, and the non-market sector are acting as a drag on those national statistics. In the case of mining, this appears to be the result of higher commodity prices incentivising the mining of more challenging deposits, but does not reflect sector profits or its capacity to pay wages. The non-market sector includes industries that produces goods or services free of charge or sold at highly subsidised prices, meaning that conventional measures of output face significant difficulties in tracking productivity. As such, to the extent that it is necessary to consider productivity as part of these proceedings, Unions WA submits that it is growth in the market sector, excluding mining, that is the more relevant measure, included on page 5 of our submissions in reply, which demonstrates that the relevant productivity growth is much healthier. If mining is not excluded, we note the Western Australian specific data we presented on page 12 of our initial submissions relating to market sector capital and labour income shares, which indicates that growth in real product wages, the level of wages relative to the price of the output that employers sell, has significantly lagged behind labour productivity growth over the last 10 years in WA. We contend too that government cost of living initiatives are no substitute for award wage increases, and we note the Commission has previously stated that one-off assistance initiatives cannot replace the ongoing beneficial effect of regular increases in minimum wages. Likewise, we do not consider that increases in the Medicare levy low income threshold or the changes to the lowest tax bracket are a replacement for wage increases. The benefits, if any, that award-reliant workers would receive will be minimal. 2, directly discounting or moderating wage increases on the basis of these measures would be to negate government action that is clearly intended to benefit the lowest paid households. I won't repeat the observations on business insolvencies made by Mr. Entrican, which was going to be virtually word for word exactly what he had said. But we do note...
submissions.
Yeah.
Thank you.
We do note there has been a net growth in the number of businesses in WA, with WA having the largest percentage increase of businesses in Australia. In reference to the observation made by Mr. Entrican regarding the conventions regarding rounding to the nearest 10 cents for the figure, we simply make the point that as the union movement will, of course, argue for every last cent to go into a worker's pocket. Finally, in relation to Clause 8B of the State Wage Order, on adjusting trainee rates of pay, as stated in our initial submission, Unions WA supports the wording of that clause, reflecting what occurs in practice when trainee rates are adjusted. Following discussions with the other Section 50 parties, we propose the wording as included in our submission and the Minister's. If it pleases the Commission in Court session, that concludes my submissions.
Thank you very much indeed, Mr. Hanson. Yes, thank you all very much for those submissions. Thank you very much. Now, Ms. Hans, do you wish to commence now? How long do you think you might be? It's 12:42.
I can finish by 1 p.m. I'll take about 15
All right, we want to
minutes.
rush you because if you want to take further time, of course, but don't feel you have to stop at 1 o'clock.
Okay.
All right.
Thank you.
Thank you.
I might move over here. Thank you, Chief Commissioner, Senior Commissioner and Commissioner. The WA Council of Social Service refers to its written submission and proposes a 4.5% increase to the state minimum wage. We strongly believe that it is essential to lift the standard of living for the low paid and enable them to better meet their basic needs. This year at WACOS, we wanted to provide the Commission with insight into the real-world experiences of people on low wages. Because at the core, we're talking about people, and numbers alone don't tell the full story. So in collaboration with Murdoch University, we've been working with 8 people living on low income, that is around minimum wage or less, to develop case studies illustrating their experiences. In our submission to this Commission, we've included 3 case studies from people who are employed. Today, I'm going to touch on a few of their experiences to illustrate the issues. And I'll start by sharing some words from Heather, not her real name, who works 2 casual jobs and earns about full-time minimum wage from her work plus some income support from Centrelink. Heather struggles to cover the cost of essentials every week and relies on support services to get by. She says, I'm a support worker at a small business, but at the end of the week, I still only pay my rent, insurance, and a few bills. I struggle to work enough hours to pay all my bills. When you look at an hourly rate as a casual, you need to work 24 hours a day, 7 days a week to actually have a decent life. Although I see the light at the end of the tunnel because I'm being promoted, it's still $640 a week for rent. And I've been breached a few times for late rent payments. There are times when I'm struggling to find the money to pay bills. But as soon as the money comes in, I pay it and they will withhold the breaches, which makes a difference. But the stress of the breach is just ridiculous. And I've had to use the rent relief program in the past for rental debt. That saved my life at the time. I get some help from friends, but yeah, it's been a struggle. A support group has been paying my Synergy account. I'm with the hardship utility grant scheme now for my gas. I get food from Food Bank, from the church, from a local pantry, and sometimes I'll contact a service that helps me with a voucher. This means I probably eat more starchy foods, which I don't really want to eat. Sometimes getting the voucher for Woolworths or Coles is easier because I can just buy the meat. And I will buy the meat at the end of the day when it's marked down to $4. For me, a best before date or an expiry, it's not an issue, but I have to pull the stickers off so my son doesn't see them. Heather certainly doesn't have the financial buffer to cover large emergency expenses. She says, I have been promoted to manager, things are looking up, but there are times that I think, if anything happened to my health, and then things like the car breaking down or about to break down, I'm driving it now thinking, is it just going to explode? It's $10,000 to replace the timing chain, but I can't sell the car in this condition now either, so I just pray. But it is scary not knowing what is going to happen in the future, really. Heather's low income forces her to make significant sacrifices, and a major one is her health. She has scoliosis, and while work hurts her back, she has no option but to keep going. This makes her back worse, so she needs more treatment, which costs more, meaning she needs to work more to earn more money. It's a catch-22. Her son has recently been diagnosed with scoliosis too, and she wants to make sure he gets treatment so he's not in pain in the future, but financially she doesn't know how she'll achieve that. She says, I do need to come up with money for the chiropractor for my scoliosis, and I've just taken my son there and now he needs to see the chiro as well on a regular basis, and that's a $1,700 commitment for 90 days, which is a lot of money. My son has the rotation thing I have as well, and I know what pain I'm in. So if I'd started earlier, then I probably wouldn't have been this bad. And that's what I think about. Okay, so my son, if I leave it, will it develop and impact him more into the future? So I don't know. I don't know what I'm going to do there. Many of the people we spoke to described the health consequences of their low income. Food, heating or cooling of their home, and medical expenses were the main essential items that people cut back on to make ends meet each week. Andy described to us the toll that this has taken on their body and their worry for how this might worsen into the future. They're 22 and they're studying full-time at university. They work part-time and receive income support from Centrelink. In total, they receive about the equivalent of 22 hours a week of work on the state minimum wage. They say, I have 1 fruit a week, maybe. 2 is pushing it. 2 is like if there's a huge sale or a really good deal. Like it's not healthy, but 7 days worth of fruit, that's so much. Then maybe I'll have a work meeting and there's fruit at the work meeting, so I'll get more fruit there. It's kind of the same with veggies. I try to aim for 5 veggies a week. I don't know what the nutritional content of onion and garlic are, but they're my go-to veggies every week and I count those. I'm definitely experiencing the costs of not properly feeding my body. I see my psychologist less than I need to. When I see him, it'll have been 2 months since I last saw him. Then I see him again in a month's time after that, if I'm lucky. Originally, it was meant to be every 3 weeks, but it's like I can't afford that, and that's not covered in the mental health plan. Last year, I got diagnosed with fibromyalgia, and I don't know, through the years, I've just noticed the constant stress of things does have a huge impact on my body. I get really scared about how it's impacting my health, like future things, like the body keeps the score type stuff. The relentless mental burden of managing their financial insecurity is a major issue raised consistently by all of the people that we spoke to in this research project. On this, Andy says, I can't imagine how freeing life would be without these constant financial pressures on me. Genuinely, I think it takes up so much time that could be spent studying, could be spent, I don't know, partying or hanging out with friends. I think it shaped every aspect of my being to what it is now. And I always get worried if this is what I've gone through so far, and it's like I'm 22, I've got how many years left of this? How many more years? What else is happening? What else is in the cards for me? Like, I hope the future gets better, but also realistically, I know there will be bumps. I guess it's just scary that it's always going to be like this. And while this financial stress impacts many, it is disproportionately shouldered by women who make up the majority of low-wage workers. WA's gender pay gap is much higher than the rest of the country, and the pay gap exacerbates other gender-based barriers women face in achieving financial security. For example, we know when women earn less than their male partner, it reinforces gender norms and incentivises women to take on unequal parenting responsibilities. Most of the women we spoke to had at some point in their lives worked in a female-dominated industry with low pay. Most had stopped working for a period of time to care for their children and then juggled caring and working throughout their careers. As a result, they had fewer savings and less superannuation than their male partners, and their income had not progressed equally. Heather and Anita, another person we spoke with, both explained that as primary carers for their children, their parenting responsibilities significantly impact how much they can work each week, and their hours fluctuate according to their children's needs. Anita described her frustration that after years of working in a low-paid industry, the community services sector, and taking considerable time off to care for their children, she is now significantly financially worse off compared to her ex-husband, who is financially comfortable. She has much less super, and her hourly wage is about 3/4 of his. Even if she could work as many hours as he does, she still wouldn't earn the same. Anita, Andy, and Heather, like everybody else, they have complex lives. But each of them, along with everybody else we spoke to as part of this research project, said simply more money would make a huge impact. Now, I understand these are 3 individual stories, but their experiences of low income are backed up by the data shared by my colleagues at Unions WA and contained in our written submission. To reiterate that point, I will quickly take you through some of that data again. Between 2021 and 2024, essential costs grew dramatically. Groceries by 24%, Perth rents by 80%, insurance by 22.6%. These price hikes caused the financial security of low-wage households to deteriorate dramatically. WACOS has been modelling income and expenses for modelled households, including a low-wage family, for many years now. For a long time, the low-wage family, with Centrelink supports and frugality, was able to make ends meet from week to week and have a very small buffer left over for unexpected expenses. From 2021, however, this started to drop quickly and severely. In 2024, for the first time since we started this modelling, the low-wage family finished each week with a deficit. Each week they were $60 short. If they had any savings, we can assume this was drawn down to cover expenses until they had to cut into essentials to avoid going into debt. Since 2024, all group CPI has moderated, currently sitting around 2.8% for Perth, and last year the Commission delivered a truly welcome increase to the state minimum wage of over 6%. You'd be forgiven for thinking the situation has been remedied, but that's just not the case. Further, non-discretionary cost growth has eroded the gains delivered to low-wage workers last year. This can be demonstrated by the percentage of full-time minimum wage required to rent a median-priced house in Perth. In mid-2020, median house rent in Perth accounted for 50.2% of the minimum wage. By 2024, at the time this Commission last reviewed the minimum wage, it had jumped to a whopping 75.3% of minimum wage. Last year's increase by the Commission provided some relief, bringing it down to 70.8%, but in the last 10 months, it's crept right back up, now at 74%, almost at the same record high of 2024. Now, we know a whole range of costs make up a basic budget. It's not just housing. However, housing is central to all other facets of standard of living. And the housing burden demonstrates the purchasing power of minimum wage workers remains severely eroded, leaving minimum wage workers struggling to afford the basics. Service reporting also backs up this data picture. Among a range of services showing this trend, This year's Oz Harvest Community Needs Survey found that 31% of the people accessing food support from their charity partners had at least one person employed in the household. And that, quote, working families still unable to make ends meet is one of the key groups experiencing particular vulnerability to food insecurity. While we have a range of living standards in Australia, at a minimum, people should be able to afford a safe and secure home, should be able to put food on the table, should be able to pay for transport to and from work, and should be able to put money away for an emergency. The wage and costs data and the people that we spoke to tell us that minimum wage earners are not achieving this. Forget about buying a friend a birthday present or having a weekend away. The people we spoke to are struggling to put food on the table and to keep their car running. By lifting the state minimum wage, the Commission can meaningfully contribute to improved living standards for low-wage workers, for women, for young people. An increase of 4.5% is absolutely warranted. And that concludes my submission. Thank you.
Thank you very much, Ms Haynes. Thank you very much indeed.
Thank you.
Now, it's 5-1. Ms Lyon or Ms Love, who wishes to... How long do you think you might be in your submission?
We're certainly in the Commission and Court Sessions hands. We don't intend to speak for very long. If you were inclined to push on, we're happy to speak now.
Well, if would 15 minutes be sufficient
That
for you?
would be more than sufficient. Thank you.
Yes, we'll sit further. Thank you very much.
Thank you. Thank you. We thank the Commission and Court Session for the opportunity for WALGA to participate in today's proceedings on behalf of the local government sector in Western Australia. We predominantly rely on our written submissions made in this matter, but just make a few points for your attention. As we've outlined in our submissions, we see that any wage increase to the state minimum wage and award rates should balance the need for fair wages with the requirement for local governments to carefully manage their budgets in the interest of their communities. We did note in our submissions there are a number of state awards that do underpin the employment of local government in WA, as we outlined in our submissions. And it's also common, and we would point out that it's common for local governments to have a wide variety of occupations within their remit. Particularly, for example, in a small regional town, they may have daycare services, cafes, even the local supermarket may fall within the remit of a local government. As we outlined in our submissions, local government employers apply either the state awards, they may also apply industrial agreements, or they may also apply what are known as new state instruments that did transition over from the federal system. We would point out, since this Commission sat in last year's state wage case, that Regulation 8 of the Industrial Relations General Regulations has now ceased as at the 1st of January 2025. And we would say that that impact has a broad impact and application for those state awards potentially applying to local government employers and should be given some weight. We would see that whilst there might be some other agreements applying, the potential for either the two main local government awards to apply and any other awards to apply, it could be fairly common into the future. As we've outlined in our written submissions, costs have risen strongly for local governments in recent years, and primarily the lever for raising revenue is somewhat constrained because any increase in rates obviously has a direct impact on the community that they're wanting to serve. I'd just take a quick opportunity to outline a little bit more around the local government cost index, which we outlined in our submission, which is an indicator that measures changes in a basket of cost items that are commonly incurred by local governments. It attempts to capture the key inputs that local governments purchase to undertake its activities, and they include both capital and operating costs. It includes matters such as employee costs, materials and contracts, furniture, non-residential building, machinery and equipment, non-road infrastructure, road and bridge construction, utilities, insurance and other expenditure. It is a measure of the change in the cost of goods and services purchased by local governments conceptually like the consumer price index, just with a slightly different basket of goods. This cost index is produced by WALGA and calculated on data provided by the WA Local Grants Commission. It's primarily used for the following purposes: to inform the preparation of annual budgets by local governments and as input for determining any rate increases, and communicating to ratepayers the cost inflation being experienced by local government, which is sometimes over and above CPI, and hence the rationale for any rate increases. WALGA regards the local government cost index as an important tool for supporting its advocacy work on behalf of its members. And you'll note we have provided at point 45 of our submission essentially the current and the forecast rate for the local government cost index. And look, just finally in conclusion, as we said, we do support a balanced wage increase, but we would note obviously particularly our smaller local governments, their capacity to pay in the face of increased cost is a factor to be weighed up. We thank the Commission and Court Session for the time.
Thank you very much indeed, Ms Love.
Thank you.
Now, we've also made provision, of course, today for any replies. Are there any replies that you're burning to make at this point from the bar table? From the I know the Minister, you commented on written submissions earlier in your.
I did. I was just going to say we didn't have anything further to add, so happy to forego that.
All right, thank you very much. Mr Harding from CCI's perspective.
We don't have anything further, Chief Commissioner.
Mr Snedden and your colleagues?
No, thank you, Chief Commissioner.
Ms Hans?
Nothing from Waycast, thank you.
All right, and I take it none from
No,
you, Ms
nothing
Love.
further, thank you.
You've had your chance, as
Yes.
they say. All right, thank you very much. Well, we're very grateful for your assistance this morning and for your written submissions that have already been filed. As I indicated earlier, we'll adjourn now and we will resume on a date to be fixed once the Fair Work Commission has handed down its decision in the 2025 annual review. So we'll adjourn till then. Thank you.